Hey folks, Andrew Packer here. Welcome to Trading Tips. Looking at dividend investments, we can see that there are a lot of great advantages. For instance, if you just buy and hold shares of a dividend-paying company, you'll never have to sell and realize any capital gains, which can be a huge impact on your taxes. And when you collect dividends, it's at a much lower tax rate than capital gains and even ordinary income. For the most part, it's as low as 15%, and there's a minimum threshold, so you can get even lower while you're building up to that level. So these are some fantastic things. And of course, there's the power of compounding, where you can reinvest the dividends into more shares, which gives you even more income. And over time, the company, if it's raising its dividend, you're going to have more shares with more income, with more shares with more income. And it's just this incredibly benevolent cycle. It may take a long time to really start to pay off and produce tremendous life-changing returns, but hey, investing's a journey, not a destination. And if you give it the time, it can do that. But there's one more advantage, and it's also the fact that, let's face it, human nature, it can be a bit tricky. For instance, say you decide to start investing in a dividend-paying stock and investing in a basket of them in your brokerage account, and then you go to a holiday party and you hear a hot tip and you decide to sell out early because, hey, this stock's going to go to the moon, it's the next big thing. And then it ends up not going anywhere, not paying a dividend, or worse, going bankrupt and you end up losing your money. Well, it can be important for some people to have a firewall between their dividend investments and, just kind of the speculative play money and taking advantages of some of those higher potential winners, but also big potential losers. So a great way to look at dividend investing is by using what's known as a DRIP, or Dividend Reinvestment Plan. Under this plan, you'll go to the specific company's website that you want to invest in, whether it's a big well-known name like ExxonMobil and General Mills, Kellogg's, any company that has a dividend policy, that's been paying dividends for a long time, will usually allow you for a minimal little bit of fees to go in, set up one of these plans for as little as $50, but usually a few hundred. And then after that, they will reinvest the dividends into more shares for you automatically. That sets you up for that compounding process, and it's outside your brokerage account. But the advantages don't stop there, because you can also set up automatic payments to just go in, say maybe you want to throw in an additional $50 a month because you feel that's all you can afford to invest in stocks right now. Great, under a DRIP, all that $50 is going at a nice price directly into these companies' shares. And typically, they'll waive fees along the way so that when those dividends come in, the full amount is going to go right back in and be reinvested into more shares. The only real downside of these, DRIP plans is the fact that as you take money out, they'll typically tend to charge you a fee there. But for saving brokerage fees, commissions, and some of the other things that might happen along the way, it's a great way to go. And of course, the DRIP program, it's not really available to companies that don't pay dividends because you're not getting extra income to reinvest into additional shares. So this is a fantastic way to ensure that your wealth can continue to grow and you can take advantage of the dividend cycle of companies that pay to regrow and compound your wealth. And you don't have to use just one company. You can start DRIP programs with 4 or 5 different companies and let them just continue to compound wealth. And then you can also have a separate brokerage account and do whatever crazy things you want to do. The other advantage of the DRIP is because it's so low cost, it actually makes a great gift. And I don't want to be that guy who gives terrible gifts, but I have a lot of friends who they're having children, they're going to need to go to college in 18, 20 years. Hey, good news. With a DRIP, we can get them set up to start investing while they're young. We can give them 18 to 20 years of the compounding effect. And if mom and dad want to pitch into that and add to that monthly, they've got an immediate way to start growing wealth, but at a small amount at a time that's affordable for most people. So if you're looking at investing and it looks intimidating and you want to just start with one stock, a DRIP is absolutely the easiest way to go. And it's a great way to get non-investors interested in and seeing their wealth grow from the strategy over time. Now, of course, I like to have my money in a brokerage account, not necessarily in the DRIP program, because sometimes I don't want to reinvest the dividends in the same stock. I mentioned McDonald's in another video. That's an example where I've been using the dividends to build out other positions and diversify my portfolio. Everyone's different, but this is one huge advantage that you just don't get with any other type of investment, and it's one that's certainly worth your time. So when you look at companies that you like that are dividend aristocrats and have been paying out money time and time again, check out their website under the investment section, because there's usually a way for you to get set up to benefit from the DRIP program. So that'll wrap things up for this edition of Trading Tips. Until next time, I'm Andrew Packer wishing you good trading and good financial health.